I'd like to mention that one of the strategies that we've had for growing the Smith Society in recent years is to look to see where we could expand our geographic footprint. And this past year, we set our sights on Houston, Texas, looking to launch both a professional chapter, and I think there are some members of the Houston professional chapter here with us tonight, and also a student chapter at Rice University. Now, being a project of the Manhattan Institute, we know the business community in New York and in the Northeast pretty well, but we were really in uncharted territory when we decided to move down to Texas. And so we were very lucky to have the support of Bobby Tudor, who has served as an ambassador for the Society in Houston generally, and at Rice specifically, where Bobby serves as chairman of the Board of Trustees. But tonight he's joining us not just as an ambassador of Adam Smith and his work, but to hopefully give us all a little bit of perspective on what the heck has been going on with oil prices lately. Bobby is the chairman and CEO of Tudor Pickering Holt & Company, a company that he founded in 2007. TPH is widely recognized for its industry-leading position in energy securities research, energy investment banking advisory transactions, and energy asset management. Prior to forming TPH, Bobby was a partner at Goldman Sachs and leader of its worldwide energy practice. He holds a BA in English and Legal Studies from Rice and a JD from Tulane. Please join me in welcoming Bobby Tudor.
Well, thank you, Allison, and good evening. It's a pleasure to be here. This is my clicker. Okay, great. If there's one thing in the world that people actually understand less than Adam Smith and economic theory, it's the energy business. So when I'm asked to come talk about the energy business to a group of students or otherwise, I always leap at the opportunity because there is just a gross underappreciation generally for how central this industry is to the well-being of the world. It is obviously, if you think about it for more than 2 minutes, at the core of what makes capitalism and business and standard of living and really modern life possible. And I think we as educated people owe it to ourselves and to the world to take time out to be educated about the industry and interested in it. So hopefully for those of you who, when you put gasoline in your car, actually don't think much about where it came from and how it got there, or when you turn the light switch on in your apartment, don't think much about whether it's because millions of years ago there was organic matter that got deposited at the bottom of the ocean that has since turned into hydrocarbon that has gone into a power plant and created molecules that go through the line into your building and into your light switch. From now on, you're going to think about that if you don't have anything else to do. So what I'm going to do tonight is take just 15 minutes or so to kind of flip through a handful of slides here that will give you, hopefully, at least an overview for where we are in the energy world today. And then I'm happy to take questions on that topic or really anything else you would like to talk about. So here we go. What's up with oil prices? Well, everyone's heard about fracking, right? So, and shale. We refer to that generally as unconventional resource, and I'm going to call it unconventional oil here. And what we've had is a revolution in that world, and with that revolution, we have a big problem, which is that we got really, really good at it in a hurry, and now have a situation that is quite typical in a commodity-based business of oversupply. So we had a huge amount of U.S. unconventional oil growth, and we created a big problem. That's not a new thing in the energy business. Ever since Captain Drake found oil in Pennsylvania, we've had these periods of boom and bust. We have a saying around our firm that anyone caught saying it's different this time is fired on the spot, actually. Because it's not different. This industry is very prone to boom and bust cycles, and we're clearly in one right now. What's different about this one is that the Saudis are not riding to the rescue. They've decided they're going to force, we caused this problem, and they're going to force us to fix it. What is the problem? The problem is that the U.S. oil and gas industry is broken at current prices. It simply does not work. And what that means is that capital cannot generate positive returns really anywhere in North America at current prices. All of the services companies that service the industry are operating at cash flow negative margins today, which, unless you have big, robust balance sheets, means by definition that is not a sustainable thing. They do not have big, robust balance sheets, so it is really not a sustainable thing. What that means is that U.S. production is now in decline. The industry is shrinking, and we believe that that decline is much deeper than most people appreciate. And I'll show you some numbers in a moment where we predict that we will in fact have an oversupplied market until about the middle of this calendar year, at which time the market will start to rebalance. That assumes that we'll continue to have demand growth worldwide. That's a big assumption and a big if for those of you who are following what's happening in China right now. And there's certainly a lot that could go wrong with that thesis. China could really implode and just kill demand growth. Of all of the demand growth that's happened in the world in the last 3 or 4 years, China alone has been about 40% of that demand growth for oil. The Saudis could grow their production to really unheard of levels. I'm going to talk about that in more detail and just what that means. Or finally, we can find that U.S. production actually declines less than we currently expect just because of technology improvements and operating efficiency. So there's certainly a lot that can go wrong. So let's a little bit of a kind of historic look. On the left-hand side here, what you see is oil production growth over the course of the past, call it 8 years or so. And we have it broken out here by a lot of different entities, but the only line that really matters is the light blue one on top, which shows you that 100% of the production growth in the world in the last 8 years has come from the United States of America. 100%. It's really a remarkable thing. And that's with oil prices at very high levels, right? So very high pricing signals. The rest of the world hasn't been able to grow production, but the U.S. has. Why? Technology, rule of law, and private ownership. The things that make Adam Smith proud. And the things that make the energy industry in the United States quite different in its makeup than what you see in the rest of the world. But this really is quite a remarkable slide. Now, a little bit of historic context. How did this happen? Like, how did we get to this place? Well, we got to this place primarily because of an entrepreneur, a man named George Mitchell. And if you haven't read much about George Mitchell, you really should. Quite a remarkable guy. A geologist trained at Texas A&M University, a first-generation Greek immigrant who started an oil and gas business after his days at Texas A&M and was kind of the proverbial tinkerer who, after having been in the business for 30 or 40 years, decided that he was going to play around with well completion techniques a la fracking and see if he could improve that technology and therefore make economic reserves that had heretofore been uneconomic. Mr. Mitchell started working on that in the late 90s, and by the early 2000s had made great progress, and by the mid-2000s had really revolutionized the energy world. That tinkering was not happening in other places of the world, and for the most part continues not to happen in other places of the world. It's been a uniquely American phenomenon. Importantly, it also was not happening at ExxonMobil, at Shell, at BP, at the great titans of the energy world. It wasn't happening there. It was happening in a very entrepreneurial level by George Mitchell and others like him. And so the industry just changed, and changed really dramatically because of this technology breakthrough. What you see on the right-hand side of the page is that almost all of this growth actually came from three places. And it was the three places that had what we call tight rock, otherwise known as shale. The big three are the Bakken, which is the yellow color, the Eagle Ford, which is the green color, and the Permian Basin, which is the gray color. Those of you who know your geography, the Permian Basin is in West Texas and New Mexico. The Bakken Shale is primarily in North Dakota, and the Eagle Ford Shale is in South Central Texas. So there was just an explosion of business in these three places, and oil production grew very, very dramatically, so much so that the United States has basically become fundamentally self-sufficient in its own hydrocarbon production, and we are actually headed to be a net exporter of hydrocarbons. Just a dramatic change in the world with all kinds of geopolitical and other implications. The problem is we were too good. And if you look at the red and the blue lines, you can see that beginning kind of late 2013 and into early 2014, supply started to outstrip demand. The gray bars here are inventory levels, and so as supply outstripped demand, inventories built, the gap between supply and demand got bigger and bigger, and in late 2014 we had a collapse in the price of oil. Our expectation is that actually this will correct, and the reason it will correct is that the U.S. is in fact a commercial system, and people respond to price signals, and when you can't generate an adequate return on capital, you ultimately quit spending that capital. Sometimes it takes a while for that to happen. There's a lag, and certainly we've had a lag in the United States, but it is happening now, and I'll show you some charts that will indicate the degree to which that is happening now. The best cure for low oil prices is low oil prices. And ultimately, the cycle will turn, and we do expect that to begin to happen in the second half of this year and into 2017. But it is fundamentally a supply and demand problem. For those of you who study macroeconomics and have studied macroeconomics, this is about as basic as it gets, frankly. That's not to say that there aren't a lot of other exogenous factors that really matter in the oil business, because obviously there are. And so you would look at my old graph and you said, wow, if we had that kind of production growth, why didn't we have a price collapse a lot sooner? The answer to that is Libya, Iran, Iraq. A ton of production was coming off of those markets for geopolitical reasons. Libya obviously was in great turmoil, as was Iraq, and Iran ultimately under economic sanctions. That gap got filled by what was happening in the United States, but all good things must come to an end, and they did. Let's talk about demand, and hopefully this will lead to some questions maybe in our last 15 minutes about renewables and the impact of renewables on hydrocarbon demand globally. But what the chart on the left-hand side of the page shows you is that with the exception of the financial crisis in 2008 and 2009, worldwide demand for oil has grown every year for the past 27 years. Now, not everywhere, but globally speaking, it's grown every year, except for those 2 years of the financial crisis, for the past 27 years. Interestingly, in the US, until 2015, we had 4 years of demand decline, as we had better mileage standards in our vehicles, better efficiencies, et cetera. But that has not happened in the developing world, where there is just, generally speaking, much higher rates of growth in demand. On the right-hand side, you see this is TPH, this is our firm's research U.S. supply forecast. And what you can see is that even though our rig count in the U.S. has dropped dramatically, And even though the industry is shrinking because of improved technology, improved efficiencies, production is actually expected to be slightly declining and then relatively flat. So for price to reset, we need to have worldwide demand growth. We are expecting worldwide demand growth. Last year, worldwide demand grew 1.8 million barrels, and to give you a kind of some context for that, the total market for oil worldwide is about 95 million barrels a day. We are currently oversupplied by about 1 million barrels a day. So when you read in the New York Times that world faces a glut of oil, well, 1 million barrels on 95 million barrels, if that's a glut, I suppose that's a glut. To me, it sounds like about 1.2%. I wouldn't call it a glut. But my point really is that barrels get priced on the margin, and it will, in fact, tend to have the same amount of volatility to the upside that it had to the downside. Let's talk a little bit about the rest of the world, because as I mentioned, there are a lot of exogenous factors here that do matter. You guys know what OPEC is, I hope. I hope everyone in here knows what OPEC is. It's a 13-member consortium, cartel, call it what you want to call it, of oil exporting countries, the largest of which is Saudi Arabia. The three largest oil producers in the world are Saudi Arabia, Russia, and the United States. We're the three big ones. Saudi Arabia currently producing about 10.3 million barrels, Russia just under 10, and the U.S. just right around 9.5 at this point. But there are obviously a bunch of other members of OPEC. Some of them, however, are quite small actually in what they produce. Ecuador, for example, is a member of OPEC. They don't really matter. Gabon is a member of OPEC. They're not a big producer. However, Saudi Arabia, Iran, Iraq, and Libya, those are the big four. And so if you look at their production history, what you see is that if you go back to this kind of shale revolution in January of 2008, basically, if you strip out Saudi Arabia, Iran, Iraq, and Libya, the rest of OPEC has been in decline and continues to be in decline. It's really just those four places that have shown any ability to keep their capacity high and increase their production. And in fact, you'll see that OPEC production of those four countries has in fact moved up and moved up fairly dramatically. And when I said before, they've decided they're not going to fix it this time, they're going to make us fix it, that's what I mean. They've kept production actually quite high and have indicated that they continue to do that. The rationale for that is that a lot of what they would call high-cost production has come on the market. When they refer to high-cost production, generally they've been referring to shale production or unconventional production in the U.S., where we require, to get break-even kind of cash flow numbers, we require much higher cost than they do. So order of magnitude, to generate a 10% IRR on production in the best fields in Saudi Arabia, they need somewhere between $12 and $15 a barrel. For the best fields in the United States, we need somewhere between, call it $30 and $40 a barrel. And for the vast majority of our production, we would need $55 a barrel or more. Well, when WTI is at $100, there's plenty of room for everybody. When WTI is at 30, a lot gets squeezed out. The Saudis and OPEC take back market share, and that's exactly what has happened. Let's talk about Iran for a moment, because obviously they're back in business, if you will, with the removal of sanctions. So you can see what happened to Iran's production over time. Arguably, they would have an incremental 3 million barrels or so of incremental productive capacity. But if you look at what was happening before the sanctions happened, they were on what we call in the oil industry base decline. That was actually pretty meaningful. Reversing base decline like that, if there are any petroleum engineers in the audience, you will know is a very, very difficult thing to do. So our expectation is that they will be able to get about 500,000 barrels a day or so back on the market in the intermediate term, and that it will be difficult for them to do a lot more than that. Talk about Saudi Arabia for a moment. They're obviously the big kahuna. As I mentioned, they have the lowest cost production in the world. They're the biggest exporter in the world. Their economy is completely dependent on petrodollars to fund their social programs and to basically keep the whole place from blowing up. And so they historically have been very, very careful about making sure that they retained excess productive capacity and making sure that prices were held at a level that allowed them to keep production levels high but generated enough of a return to keep the world in balance. With the U.S. shale revolution, they decided they had to react to that, and so they have reacted to that by increasing their production pretty dramatically. And you can see that since January of 10, they've gone from about 750,000 barrels or so to today somewhere around 10.3 million barrels. 7,750,000 to about 10.3. So very, very dramatic increase in Saudi Arabia over this period of time. We believe that they want to keep some excess capacity in the system, and they'll top out somewhere around 10.4 million barrels, but this is a bit of a wild card too. And one of the questions people ask, well, what's really to stop the Saudis from going from 10.4 to 11 to 12? We think their fields won't take that, if you will. There are technical reasons that's very difficult for them to do. And in fact, what they say publicly is that they wouldn't expect to get much above about 10.5 million barrels, and to us that sounds about right. What has happened to U.S. production? Well, it's rolled over, meaning it's starting to go down. And the reason it's starting to go down is we've quit drilling for oil. This has had enormous economic impact, certainly on the oil-producing states. I would argue that its economic impact is just starting to be felt in the broader U.S. economy. There was a period just after the financial crisis from 2009 to 2012 where something like 50% of every net new jobs, of all net new jobs created in the United States were happening either in Texas or in North Dakota. 50% of every net new job. And of that 50%, 25% were happening in greater Houston, Texas. So Houston was really, really a boomtown kind of from 2008 to 2000 till last year, till 2015 or so. But with the decline in rig count and with the retrenchment of capital providers, production is declining and is starting to decline pretty rapidly at about the rate of 75,000 barrels a month. So peak to peak, kind of if you go back to April of 2014, which would have been sort of the peak price period and take that from 6.8 million barrels to 7.4 million barrels in 2015, we're decreasing now at a rate about 75,000 barrels a day, so we'll be down, we think, year over year, something like 750 or 800,000 barrels, which is a very, very important balancing fact. So why are we decreasing production so dramatically in the United States? It's because you can't make money. And one of the great things about the business in the United States is that if you can't make money doing it, you don't do it. You quit spending capital on it. Capital providers pull the capital back, and that's generally what's happened. So what these two charts show you, on the left-hand side is the oil-weighted basins in the United States. So it's the Permian Basin, and it's the DJ Basin in Colorado, and it's California, and it's South Louisiana. It's all the places that oil and gas are produced in this country. It's Appalachia now, the Utica Shale, the Marcellus Shale, et cetera. And you can see that to generate a 10% IRR in all of those places, you need oil prices much higher than we have today. So you have oil on the left and you have gas on the right. What these two charts are telling you is that you cannot drill for oil economically, basically anywhere in this country today. So how has the industry responded? Well, we quit drilling. So if you look on the left-hand side of the chart, you can see the rate of rig count decline over a series of big downturns in the industry. The red line is the most recent one. So basically, we have had a 70% decline in the rig count in the United States over the course of the past call it 18 months or 2 years. That is just a really radical sort of retrenching of the business. The job losses associated with this, of course, are very, very dramatic. Order of magnitude, we've lost more jobs in this industry in the last 18 months than all of financial services job losses in the financial crisis, plus all of auto industry job losses in the financial crisis. More jobs lost here in the last 18 months than you saw there over that period of time. Interestingly, and one of the things I love about living in Texas is that you don't hear a lot of why isn't the government helping us, right? What you hear is, well, you know what? We're not going to drill, right? If it's not economic, if we can't earn a reasonable return on our capital, we're going to pull our capital away and retrench. And as far as I'm concerned, that's exactly how markets are actually supposed to work. There's more detail here around the rate of rig count decline and the rate of capital spend. So one of the difficult things about the shale business is it does require huge amounts of capital, and typically capital in excess of the cash flow that you are generating. So it's been a debt-fueled boom, and those chickens are coming home to roost, as they say. This cash flow outspend over time has added a lot of stress to the business, and so we're now going through a major restructuring phase in the business, a fair amount of bankruptcies. Last week, Southwestern Energy laid off 1,200 people in one day. A few months ago, Halliburton laid off 6,000 people in one day, et cetera, et cetera, et cetera. Companies are being forced to live within their cash flow. Our view is that's good news because it will allow the market to rebalance, and we will be back in business when it does. However, the stock market is arguably kind of not on board, meaning that the stock market is assuming a reasonably quick bounce back in energy prices and thus relatively high fundamental values for these companies. So what these two charts show you on the top, we take all of our net asset value models for all of the U.S. upstream publicly traded companies, and we run a $75 long-term oil price and a $3 long-term gas price. And to give you context, today oil price is 30 and gas price is 2. We are a long way from 75 and 3. And even at 75 and 3, about half these companies actually trade at a very meaningful premium to their NAV. The bottom half of the page is at a lower price deck of 60 and 3, and what this tells you is there's no equity value. There's no equity value in the industry at $60 and 3. Remembering we were at 30 and 2 is actually where we are. So the market is still arguing that, in fact, this will reset. It will reset reasonably quickly, sometime in the next year and a half or so, and that therefore there is fundamental underlying value in the business. Probably some of you are going to work for private equity firms or have worked for private equity firms, and this should be good news generally for private equity firms, those with dry powder, as they call it, sitting on the sidelines kind of licking your chops, ready to put money to work. In fact, there has not been a lot of money put to work just yet from private equity firms, and one of the big questions is sort of why not, and will we see it? But the point is, assuming 2 times leverage, we have a couple of $100 billion of dry powder, energy-focused private equity ready to grow to work in this business, and we expect we will start to see some of that over the course of the next year. So, in summary, the industry doesn't work at 40 WTI, never mind 27, which is where we were about 3 or 4 days ago when I wrote this slide. The best cure for low oil prices is low oil prices. So the number one rule, if you are in this business, is survive. The best companies will survive, but many others won't. That, of course, creates great opportunity in the market of the energy world. There will be forced asset sales, there will be mergers, there will be rescue financing. Who wins? Well, in America, the lawyers, the bankers, the CPAs, we always win. Of course, if you're a consumer of gasoline or diesel or jet fuel, you're winning in a big way. Or if you're a refiner and industrial user, you're winning as well. In effect, we've had actually a very big tax cut for consumers over the course of the past 18 months or so. It's real money in the pockets of many Americans. Slightly ironic and puzzling that right on top of this, our administration would suggest what we need to do now is put a $10 a barrel tax actually on the energy business. But I suspect that's kind of DOA. It's a very interesting time to be in the energy world. There's a lot happening. It gives you a real appreciation for how markets work, particularly in our country. And I think, frankly, it says great things about the U.S. economy and the market. We will work our way out of this. We will make money again. And after we do make money again, we'll lose money again. Because that's the nature of the energy business. Thanks so much for having me. It's been a pleasure. I'm happy to take questions. Please.
On slide 10, you had a couple diagrams of the relative economic potential for each of those different shale fields.
Right.
And it brings me back to something I've been reading about, which is that there's likely to be a price ceiling going forward. You said shale's capital intensive, but certainly less than offshore. I'm curious if you think that we're not ever going to see, well, next 10 years, $75 a barrel, because all of these fields can come up again if the price gets in striking distance.
Right. Well, it's not that simple. However, we do think the next price peak will be lower than the previous price peak. And the reason for that is technology and efficiency. So as the companies have worked on this for the last 5 years, they've just gotten better and better. Most people really don't appreciate what a technology-heavy world the energy industry is. And we're actually in the very early days of big data really having an impact in the energy business. But the energy business is full of engineers and scientists. That's who make up this world. And they make things better and more efficient and more effective by working on them and worrying about them and doing R&D and doing what scientists do. And so what that means is that we've driven down the break-even price in most places by, call it $20 or $25 a barrel. So if you were a producer in the Bakken in North Dakota to generate a 10% IRR 2 years ago, you would have needed, call it a $70 price. Today you need $55. And it's really a function of technology, and technology will continue to improve. However, from the producer's point of view, they expect to be able to generate the same per barrel margin at $55 with better cost and better technology than they did before at $75. Yes?
Thanks for being here today. Some people argue that rig count doesn't really matter as a metric because productivity per rig has increased so much.
Right.
Do you agree or disagree with that, first of all? And second of all, when oil prices do eventually stabilize, how will the productivity of American rigs affect how the next positive cycle plays out?
Well, productivity of rigs and of completion technologies generally have clearly improved and improved really dramatically. So if the way we think about it is the peak of the rig count in 2014 was about 2,200 rigs working in the United States. We currently have about 550 working in the United States. We think to keep production flat, we'll need about 1,100 rigs. And to grow production at 5% a year compounded, we'll need about 1,400 rigs. So that gap between, call it 2,200 and 1,400, that's all about efficiency. It's about better technology, smarter application, and just learning as you go. We will not need as many rigs as we did before. That's why if you're an owner of publicly traded land drilling stocks, you see them off 80% and 90%. It's clear that we have way too much capacity in that part of the business, and that capacity needs to be taken out. But you know what? It'll get taken out. Because what happens here is that the productivity gains tend to stick, but a lot of the cost gains otherwise don't stick, right? You get those gains on the way down, and then when capacity comes out of the market, you give up a lot of those gains on the way back up, particularly when it comes to people costs. This business is still a very people-intensive business, And one of the things that's a little unusual about this big downturn is that people who get laid off at Halliburton or Baker Hughes or Southwestern Energy or you name it, they've actually got pretty decent options right now, particularly in the petrochemical business. So they get in their truck and they drive from Midland to the Houston Ship Channel and they go to work for Dow Chemical on a major plant expansion. And the reason they do that is because feedstock costs for Dow Chemical are at historic lows, right? The refinery world is booming. Petrochemicals are booming. So it's actually a very healthy job market for skilled laborers from the oil patch. And thus, when capacity comes out of the market, price stabilizes at higher levels, and people want to put rigs back to work, to get your crews back is actually going to cost you more money. So you're going to give up some of those costs on the way back up. Adam Smith could have told you that an awful long time ago, actually.
Hi, I'm Carlo from Brandeis. First of all, I want to say I come from a country where the oil price, the gas price is usually 4 times what it is here.
Right.
So we're very welcome to those low oil prices. But besides that, do you think that besides the economic rationale we're talking about until now, do you think that the low oil prices are beneficial for geopolitical equilibrium? Because countries that suffer the most are seen as, I don't want to get political here, but as bad countries, like Russia, Saudi Arabia, Iran, Iraq, Libya, Venezuela. What countries that benefit are like Western Europe, for example, has benefited a lot. So what's your take on that?
Right. Well, it is clear that a lot of countries in the developing world in particular who have had the great fortune of being commodity rich and oil rich in particular have done an awful job of being stewards of that resource and have basically used that resource for kleptocracy, really. But it doesn't have to be that way, is the point. It's certainly not that way in the United States. It is not that way in Australia. It's not that way in the UK. It's not that way in Norway. So I would argue this notion that it's a curse, if you will, to be rich in natural resources is nonsense. The curse is to reject free markets and capitalism and democracy. And if you make the choice to reject those, you pay the price, and I would argue that's what they're paying. The great thing about this sort of technological revolution that's happened in the energy world is that it should in fact drive down the cost of energy for everyone in the world. It's much more accessible and it's much more easily transportable, natural gas in particular. And what it should do is have a very positive effect on standards of living everywhere, particularly in the developing world.
Thank you.
Mm-hmm.
Hi, my name is Jim Royce from Georgetown McDonough. Thank you very much for being here. It was an excellent analysis about the factors regarding supply, but I wanted to ask you about demand. If I understood your chart correctly, you said that demand has averaged a 1% growth over the last 27 years, which I don't think even keeps up with population growth. So I'm just wondering what factors you see impacting demand going forward.
Right. Well, the demand related to population growth has been offset by demand decline related to efficiency, right? So everything from cafe standards to LED light bulbs to you name it, right? We're getting more efficient. We are conserving our resources better. We're much more sensitive, obviously, to the environment and to pollution and to climate change. And so you roll all that together, you have areas of the world where demand is declining, but you also have areas of the world where demand is increasing pretty dramatically. I have a friend who says, in China, once they get off the bicycle, they don't want to get back on the bicycle. And of course, diesel demand and gasoline demand in China has grown really, really rapidly. The numbers that we've seen just in the last couple of months in India, for example, have just been mind-blowing. India is going through a massive period of growth as well. Would we expect this to tail off over time? Yeah, over time, we would expect it to tail off. But the likelihood that we will be consuming less hydrocarbons in this world in 2025 than we are today is very low. Notwithstanding that we expect renewables, certainly in the West, i.e. North America and Europe, we expect renewables to grow meaningfully and take a higher share of the total power generation market. What's going on in the rest of the world is going to keep demand for hydrocarbons quite high, we think. That's a challenge for the environment. It's a challenge for the world. But it also dramatically impacts standards of living for people, particularly people who are trying to come out of poverty.
Thank you.
Yes.
You actually just sort of answered my question, but I also come from Georgetown. I imagine the rhetoric in our nation's capital about the role in government is slightly different than what you encounter in Texas. But I wanted
Move to Texas.
Perhaps. I wanted to ask broadly about the role of renewables, and have we seen a change in demand following the price bust with traditional or unconventional hydrocarbons in this country?
Well, yeah, my perspective on renewables is that I do think they will continue to grow as a share of power generation in particular. It's not clear to me that we're within striking distance of them becoming a meaningful component of transportation fuel in this country anyway. But as a component of power generation, we clearly do see growth in renewables, and the reason we see growth in renewables is they're becoming more economically competitive. My observation is that people's willingness to pay more for renewable energy is more a matter of theory than it is a matter of fact. And that particularly in more difficult economic times, people's willingness to do that goes down. And so the absolute amount of the growth of renewables is going to be very driven by how competitive they are economically with traditional sources of fuel, whether it's power generation fuel or transportation fuel. And the good news is they are becoming more competitive, absolutely. Distributed solar in particular, in many cases wind. In the state of Texas, for example, almost all the growth in power generation in the next 3 years, almost all of it is actually expected to come from renewables. A little known fact, what's the biggest wind power generator in the United States? Texas, not Massachusetts, it's Texas, right? And so, yeah, I mean, we expect them to grow and actually to grow meaningfully, not just here, around the world. What is the appetite of our citizenry to continue to underwrite pretty massive subsidies of those to make them economic for the installers and the power companies who are doing them? That's a big open question and not so clear to me, which is why at the end of the day, we just have to invest in R&D and drive down the cost so that we can have more clean fuels.
Thank you.
This will be the last question over here.
Mr. Tudor,
I'll come back to you.
Here.
We'll make it two. Sorry, go ahead.
So one of the theories is that when the oil prices rebound, all the high-cost producers will go back online, which will result in OPEC taking aggressive action again, trying to drive them out. So, the situation that we have today would probably repeat, or do you think it would not? Something would be different.
Like I said, anyone caught saying it's different this time is fired on the spot. Oh, I agree. I agree. Are we prone to reasonably high volatility in energy prices? Yes, I think we are prone to it. The nature of the unconventional revolution is such that you actually, one of the things you have to remember about what's different about this business is that you've basically taken geologic risk out of the picture, right? In the traditional oil and gas business, you risk huge amounts of capital to go drill for new reserves. You don't know whether it's there or not, right? technology has improved dramatically over the last 25 years with 3D seismic and things like that, but you really don't know when you're risking huge amounts of capital not knowing whether you're going to find commercial quantities. In the unconventional world, you are positive commercial quantities are there. The only question is, can you get your costs low enough to get them out economically? And as our expectation, as the industry gets better and better and better, they will continue to drive down that cost curve so that the break-even cost required will be quite low. What's challenging to the Saudis is what used to be high-cost oil, the Bakken or the Permian, is now kind of medium-cost oil. And the question for them is, at what point does it become low-cost oil? And I am hopeful that that's exactly actually where we're headed.
Thank you.
Last question.
Russell Greco, Rice University. I know we talked a lot about unconventional oil. The other fuel that we talked about a lot about other years ago was unconventional gas.
Right.
And I'm curious about what you think about the rebound on natural gas prices. How do you see that playing out, similar to oil or otherwise?
There's no hope, is the short answer. Look, this revolution actually started with gas. It really didn't start with oil. The Barnett Shale, George Mitchell's little laboratory, was gas. It was not oil. And there are just massive, massive reserves of natural gas around, which is fantastic news for the U.S. and for the world. It's obviously a much cleaner, much more, it's much cleaner than is oil and diesel and coal. And it is growing and growing dramatically as a component of the world's kind of generation fleet. In some sense, the issue is we just have too much of it. It is all over the United States. It's in Appalachia. It's in the Rockies. It's in the Gulf of Mexico. It's in the Haynesville Shale of Louisiana, et cetera, et cetera, et cetera. And it still competes with coal in power generation. So the problem is, if it ever gets above about $3, power generators switch from gas to coal. And with worldwide pressure on the retirement of coal fleets, there's downward pressure on coal prices. And so that crossover point keeps getting lower and lower. So our projection is that it's hard for natural gas prices to get much above about $3 in MMBTU and stay there for any period of time. But we do think more and more will be produced, and it will be used as cleaner burning fuel in power generations, and hopefully ultimately in transportation fuel as well. I think I'm out of time, you guys. Thanks so much for having me. Thanks for the good work you do.